Welcome to the Credit Risk Management Advisory Podcast, where we focus on managing asset quality and borrowers during economic downturns. Today's credit risk memo tool is the credit risk evaluation process. At creditrma.com, we help sharpen regulatory credit risk rating and evaluation systems and support a credit culture that respects all internal stakeholders and every commercial borrower. We also examine key creditor tools to help improve our outcomes. Let's dive in. The main objective today is to get a refresher of understanding the credit risk evaluation process, particularly in the timely and accurate assessment of rating credit risk. The takeaway exception is that this is a team approach with the primary relationship officer in the driver's seat, the credit administrators working closely together as the credit risk changes. Two or single-tier risk rating system. The two-tier rating system, this is a process that is accomplished in stages. The first is to establish a borrower risk rating, or a BRR, and a transaction risk rating, or a TRR. The TRR, the latter, is used for regulatory reporting. Back to the BRR. The BRR starts with a thorough analysis of the borrower's ability to repay in establishing the BRR. The BRR is based on the general financial strength of the borrower or the issuer and is independent of any transaction issues such as structure, collateral, or guarantors. It is an overall assessment of a borrower's financial and operating strength, including competitive issues, quality of management, financial reporting issues, the industry, or economic factors, including the borrower's current and expected financial condition, their cash flow, liquidity, leverage, free assets. Next, the borrower's ability to withstand adverse or stressed conditions. Next, the borrower's history of servicing debt, whether projected or historical repayment capacity are corrected, and the borrower's willingness to repay. Next, also underwriting elements in the loan agreement, such as loan covenants, amortization, and reporting requirements. And qualitative factors such as the caliber of the borrower's management and the strength of its industry and the condition of the economy. And as far as a TRR, or a transaction risk rating, that's established after the determination of the BRR, taking into consideration in particular the structural elements enhancing the loan transaction, including the existence of collateral quality and control, and guarantees and third-party support, even transaction risk for currency conversion. And if there's just a single-tier risk rating system, use the BRR approach. And of course, anything that's cash secured, for example, would be rated as a pass. Now we're going to dive into some of the quantitative and qualitative factors behind risk ratings. Quantitative financial statement analysis. Everybody's familiar with this, hopefully, but let's just review what they are. This is analysis of revenues, profit margins, income and cash flow, leverage, liquidity, and capitalization. It should be sufficiently detailed to identify trends and anomalies that may affect the borrower's performance. Specifically on cash flow, business cash flow is the operating revenue derived from ordinary business activities, less operating costs paid but not simply incurred, plus non-cash expenses such as depreciation and amortization. Changes in working capital accounts, capital expenditures, and other uses of cash should be reviewed to understand the cash flow implications. Next, the ratio analysis and benchmarks. Analyze vital information about balance sheet and income statement proportions. Compare borrowers' financial ratios with prior periods and industry or peer group norms to identify potential weaknesses. Noted ratio deviations should have identified root causes. In other words, as you do the analysis and help determining these risk ratings, you actually have to dive deep enough to get to the root cause. The next would be the analysis of projections. Expected performance should be measured against historical performance and how likely they will be achieved, and you can opine on this. Consider multiple scenarios, right? The stressed or downside case, the break-even, the borrower management case, and of course the bank base case. Refinancing. Loans for which refinancing is a source of repayment should only be made if the borrower has the capacity to repay the loan, either through business cash flow or the liquidation of assets. A loan whose repayment continually relies on refinancing, you've heard of it before, evergreen loans, or whose borrower fails to achieve successful recapitalizations, requires added scrutiny. Such loans are speculative at best and may warrant an adverse rating. Let's take a little look at some of the qualitative financial considerations. Qualitative analysis of sound underwriting, management, and the borrower's industry, conformance to bank policy, with any exceptions adequately mitigated and documented. In terms of underwriting, of course, is the process by which banks structure a credit facility to minimize risks, or so they can be properly managed, and generate optimal returns for the risks assumed. Sound underwriting provides protections, such as coordinating repayment with cash flow, covenants, and collateral, thereby increasing the likelihood of collection. Management address the character, capability, stability of the management team. It considers their qualifications, their experience, effectiveness in developing and implementing appropriate business and financial strategies. Competency and integrity, this cannot be overstated. The ability of managers, especially during a downturn, to guide, exploit opportunities, develop and execute plans, and react to market changes is extremely important. Expected loss of one or two key employees can be detrimental. Even the most experienced management teams can be challenged by high growth, which can be a common reason for business failure. Next, the industry. Understand the conditions in which a business operates and the cyclical, competitive, and technological changes that it's likely to experience. Most industries exhibit some degree of cyclical volatility, and some industries are exposed to seasonal variances too. Such volatility affects the operating performance and financial condition. Technological change and new competitors or substitute products also can affect performance. These things should be adequately understood. As far as the transaction risk rating goes, credit risk can be moderated by enhancing the loan structure. Parties to a loan can arrange for mitigants such as collateral, guarantees, letters of credit, credit derivatives, and insurance during or after the loan is underwritten. Credit mitigants primarily affect loss when a loan defaults and, except for certain guarantees, generally do not lessen the risk of default, as you know. But what about collateral? Collateral is any asset that is pledged, hypothecated, or assigned to the lender, and that the lender has the right to take possession of if the borrower defaults. The lender's rights must be perfected through legal documents that provide a security interest, mortgage, deed of trust, or other formal lien against the asset. Once the lender has taken possession of the collateral, loan losses can be reduced or eliminated through the sale of the assets. The level of loss protection is a function of the asset's value, liquidity, and marketability. Realistic collateral valuation is important at loan inception and throughout the life's loan, but it becomes increasingly important as the borrower's financial condition and performance deteriorates. Loan guarantees. Loans may be guaranteed by related or unrelated businesses, and individual guarantee agreements should be as precise as possible, stating the specific credit facilities being guaranteed, under what circumstances the guarantor will be expected to perform, and what benefits the guarantor received for providing the guarantee. Guarantees can be unconditional or conditional. If a guarantee is to enhance a credit risk rating, the guarantor must display the capacity and willingness to support the debt. A presumption of willingness is usually appropriate until financial support becomes necessary. At that point, willingness must be demonstrated. When adequate evidence of guarantor performance is lacking, the guarantee should not have a beneficial effect on the risk rating. And, I mentioned earlier, letters of credit. An LC is a form of guarantee issued by a financial institution. An LC rarely protects against default risk, unless it specifically can be drawn on for loan payments. An LC issuer is typically more creditworthy than a guarantor. When an LC that protects against default is obtained from a high-quality institution, it may effectively prevent default and losses. The issuer's low credit risk substantially mitigates the borrower's higher credit risk. Before a loss scenario could develop, both the borrower and the LC issuer would have to default. An LC can be irrevocable, which means all parties must agree to its cancellation, or revocable, which means that the LC can be canceled or amended at the discretion of the issuer. Revocable letters do not mitigate credit risk. A standby LC pays only when the obligor fails to perform. This short ad is sponsored by the Debt Crisis Problem Podcast. Attention listeners, please join us at tunabudget.com to tune into the Debt Crisis Problem Podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore these critical risks and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. Finally, let's finish up with another refresher, or take a little closer look at 14 structural weaknesses that also need to be taken into consideration. And these structural weaknesses are underwriting deficiencies that can compromise the financial institution's ability to control a credit relationship if, like I said, if economic or other events adversely affect the borrower. So evaluate the relative importance of such factors in the context of the borrower's overall financial strength, the condition of the borrower's industry or market, and the borrower's total relationship with the financial institution. Again, these are the things like, for example, third-party reviewers, be they regulatory or internal credit review function, they'll take note of these things as they review their loans. First, an indefinite or speculative purpose. The loan purpose should clearly reflect the actual use of the proceeds. Loans for ambiguous or speculative purposes deserve extra scrutiny. Next, indefinite or overly liberal repayment program. Loans that lack a clear and reasonable repayment program, source, and timing present extra risk, regardless of their nominal maturity. This includes loans that revolve continually or evergreen loans, where the bank is essentially providing debt capital. Typical indicators of unrealistic repayment terms include bullet maturities unrelated to the actual source of repayment funds, rewrites or renewals for the purpose of simply deferring a maturity, loans used to refinance asset purchases with a repayment plan significantly more than the useful life of the asset, and advances to fund interest payments. Next, non-existent, weak, or waived covenants. Whereas effective covenants provide the bank with the opportunity to trigger protective action upon covenant default, be alert for covenants that have been waived or renegotiated by the bank to accommodate a borrower's failure to maintain the original standards. Make use of meaningful covenants. Inadequate debt service coverage, of course. The initial underwriting of loans that are intended to be repaid from operating cash flow should provide for an acceptable margin to repay both principal and interest in a reasonable time based on historical performance, right? If repayment is predicated on new revenues that are expected to be enabled by the loan, then anticipated future cash flows should be reasonable and well documented. Next, elevated leverage ratio. Acceptable leverage ratios vary based on industry, loan purpose, covenant definition, capital expenditure restrictions, and dividend payouts. Review the reasonableness of the leverage ratio and how it is defined. Leverage ratios may be calculated as debt to worth or debt to cash flow, and industry standards prescribe which methodology is most appropriate. Next, inadequate tangible net worth. Companies need tangible net worth to sustain them during the unforeseen adverse situations that always seem to come. Consider both the absolute amount of tangible net worth and its amount relative to debt. Next, insufficient collateral support. This occurs, of course, when the borrower is not deserving of unsecured credit, but is either unwilling or unable to provide a satisfactory margin of collateral value. Consider senior liens, the costs associated with liquidation of the collateral, and the potential reputation risk that might influence the institution's willingness to liquidate, including lender liability issues. Next, inadequate collateral documentation and valuation. Collateral should be documented by evidence of perfected liens and current appraisals of value. Federal regulations, for example, govern the appraisal requirements related to many forms of real estate lending. Other unregulated types of collateral should also be supported by appraisals or valuations reflecting an economic value commensurate with the loan terms. Loans for which the bank is not materially relying on the operation or sale of the collateral as repayment, for example, the bank has truly obtained collateral as an abundance of caution, should not be included in this category. Overly aggressive loan-to-value or advance rates. Of course, LTV and advance rates should reflect the useful life of the collateral pledged, the depreciation rates, or vulnerability to obsolescence and market volatility. Loans-to-cost relationships should also be considered, particularly for commercial real estate projects. Next, inadequate guarantor support. Guarantors may serve a variety of purposes in the credit process, including as an abundance of caution. Analyze the guarantor support in the context of the financial institution's actual expectations of the guarantor, as well as the guarantor's willingness to support the credit if called upon to do so. Inadequate guarantor support may result when the institution relies on the guarantor's presumed financial strength, but has not fully analyzed the guarantor's financial information, including contingent liabilities and liquidity. Inadequate guarantor support may also occur when a guarantor whose support was critical to the original credit decision is subsequently released from the obligation without other offsetting support. And next, repayment is highly dependent on projected cash flows. Where repayment relies heavily on optimistic increases in sales volumes or savings from increased productivity or business consolidation, may also include loans whose projections do not adequately support debt service under the duration of the loan or whose projections rely on an unfunded revolver or other external sources of capital or liquidity. CRE loans with limited or no pre-leasing or sales should be considered for this category. Next, repayment is highly dependent on projected asset values. Where loans that are projected to be repaid from the conversion of assets at a value that exceeds the current value when the project depreciation is not well supported, then it may also include loans for which the LTV is too thin to weather a decline in value resulting from normal economic cycles. Next, repayment is highly dependent on projected equity values, where loans that are predicated on the projected increasing value of the business as a going concern fits this category. These enterprise value loans typically have all the business assets, including goodwill and stock of the borrowing entity, pledged as collateral. Enterprise values can fluctuate widely, especially during economic downturns. And lastly, repayment is highly dependent on projected refinancing or recapitalization, where loans are made based on the expectation that proceeds from the issuance of new debt or equity will repay the loan. These are not bridge loans pending a closing. Rather, the future debt or equity event is uncommitted or has other elements of uncertainty. It may rely on optimistic assumptions about the future direction or performance of debt markets, equity markets, or even interest rates. Thank you for joining us. Today we covered credit risk management evaluation process, another essential tool for managing asset quality and commercial borrowing relationships. And we want to hear from you. Submit your own credit risk memo at creditrma.com and share your insights on navigating credit risk, including special risks in commercial lending. If you found today's episode valuable, please subscribe for updates on future podcasts at creditrma.com. Until next time, let's conquer credit risk challenges. Thanks again.